Welcome back, dividend growth and value investors. In today's video, I will discuss an entirely new position in my portfolio. And it's not just another position. This is a real dividend king with 50 years of consecutive dividend growth. Can you figure out already which stock it is based on this beautiful chart porn? If you do, that's of course really awesome. But before we get into it, in today's video, I'll share a little bit more about its business background, the current situation they operate in, and we'll dive a little bit deeper into their latest 10Q so that we really make sure that we exactly know what we own. Only after that, I'll share with you my dividend safety profile and the estimated fair value of the stock. But hey, let's get started, and without further ado, the stock I just initiated a new position in is Target. Just in case you don't know what Target is one of the larger retail chains in the United States. As you can see, Walmart, the leading grocery store with 21% market share. This is just astronomical. But look at Kroger, 10%, Costco, 7%. But even for the fanboys of Ahold Delhaize, in which I have a really large position, 5.2%. Target is at place 8 or something like that with 2.8% market share. And in the past decade alone, let's say, Target Corporation has been able to gain its competitive advantage from where it was before by offering unique and diverse products at an affordable price. This is really what Target is known for. It has been able to provide high quality products through its wide variety of brands while keeping prices low. But as you can see, there's still so much more room to grow for them. From that point of view, I really see no reason why Target can't add another 25 years of consecutive growth on top of it from where they are today. And why I'm thinking like that is because I studied their history and they've got a really nice website on here. So the company was founded in 1960s. They've been paying a dividend, by the way, since 1967. And what I took away from this, right? They are actually quite an innovative company. I mean, let's not look at the creation of its iconic logo as we know it still today. This was in 1962. But for instance, they started already providing quite early employee incentives. I believe it was somewhere in 1972 or 1975, where employees would get a 10% discount within their grocery stores. But also really a lot about their history is about technology adoption. I believe, what was it, in 1986 or something like that, they already installed their first email system over there. Now, I don't know what you were doing in 1986, but I can tell you, most of the people I knew at that time were not using email yet. So to do this already, on a company-wide initiative, I think is quite showing the evidence of early technology adoption. Also in 1999, and they were actually starting to partner with another company that I have a position in, and that is Starbucks. So in 1999, they also already started creating these in-store experiences that they have, and they have now several hundreds of them. If we just fast forward a little bit to this era, more around 2013, they already had a pick up and collect. And of course, it's an internet era that we are growing up in right now. But in 2013, we're talking about 9 to 10 years ago. If you think about the whole digital movement of in-store pickups and everything, really came just in the last 4 or 5 years. So for me, to be able to do this already so early shows just that they're early adopters. It doesn't mean that everything pays off straight away, but of course they then have the power to quickly scale up when it's really, really needed. And the last thing that they really invested in was in 2017. They did a 7 billion store remodeling, which resulted in most of the Target stores as how you know them today. And I vividly remember that because then at that moment in time, Target was trading at a 4% yield or something like that because Amazon was going to wipe out all the retailers. I bought Ahold Delhaize then quite a bit, also at €15 or something like that, which was really for me a discount deal. But I still regret until today that I didn't buy Target. I didn't know really what to expect from it because, it's hard for a European to really appreciate Target. After that, I've been few times in the States. I have seen some stores of them and I enjoyed them. Not, of course, to be representative for the whole sample of Target stores, but I got at least a little bit of a feeling with it. So for me, its history is all about early technology adoption and really innovating in this area and what it has resulted in today. In 2021, 106 billion in revenue. You need to know that 2-3 years ago, it was only doing 80 billion in revenue. So COVID was really helping them to quickly scale up. almost 2,000 stores all over the US, and they continue to invest in it because also there are dozens of new store openings coming up. As you can see, a lot in California here and Florida. So this company is still growing, maybe not anymore so much as in its early days, but that's fine. These are mature companies, and this is what we also often see as dividend growers. So if we take a closer look at their most recent earnings, and what I like is that if you compare it to last year's big bump of almost 10% comparable sales growth, Target is still able to pull it forward. This is really, really impressive for me. Traffic increased by 1.4% year over year, and their basket size 1.3% over year. But to be honest, their earnings were not so shiny. If we just look at the highlight earnings that they have here, their operating margin is just at 3.9%. Although it even improved a little bit compared to the last quarter, it doesn't matter. The company actually lowered its top line and bottom line expectations for the next quarter. So what happened to the share price consequently? You can see here around this time the earnings were released, $178 to boom, $155. And the company has been just struggling from a share price actually already the whole year, as you can see. It has not been a good year for people that are depending on its capital gains. But from my side, if I look at this, look at that. $260 like in August 2021 and now $152 at a 2.84% yield. Is this then maybe the time that this stock is really becoming attractive for us to start initiating a position? Well, for that, I really want to go a little bit deeper into the earnings report because, we really need to understand what is happening and why this company is trading down. So, I'm just going to show you really quickly the highlights. I went through the whole 10Q. I studied it for more than 1.5 to 2 hours, read everything. So I got a kind of a grasp on where it's going. And the first thing I want to highlight you here is that if we go to the income statement, what you can see here is that for the full 9 months, right, and a lot of this is also due to Q2 this year, you can see that the cost of sales increased from 52 billion to 58 billion. Keep that in mind soon. That's the only thing you really should remember from the income statement, I would say. If we then go to the balance sheet, you can also see here that inventory was building up quite significantly with almost 4 billion compared to the start of the year. And at the same time, they don't have a lot of liquid money anymore left on their balance sheet. It's not an issue, 1 billion. It's an A2 balance sheet. This company is really strong capitalized, so don't think it's an issue in itself, but you can see that the money went mostly in its inventory. If we then go to the cash flow statement, what's really good to know here is also that the free cash flow dropped significantly and is actually in a minus right now. The reason for that is that last year they had positive working capital contributions because accounts payable was 3.2 billion. What it effectively means is they gained goods from their suppliers, they just hadn't paid it yet, and that's why it was a positive entry into the cash flow statement because there was no hard cash going out. Of course, this year looks a little bit different, and that's why there is a big gap between the 2 years. So you also need to take that into consideration. At the same time, expenditures for property and equipment almost doubled. Well, the reason for that is, if you go into the transcript of this call, which I also listened to the investors call, is that they are really, really stepping up the remodeling of more stores again to really pull it up to 2023 levels of what modern retailers should offer. So the company continues to invest, and it doesn't expect to continue investing this much as it did now. Although stores, of course, are becoming more important. Also on the cost side, inflation is happening here. But it is something that does make a big difference between 2 years, and that's where the explanation is. Now, these are the 3 highlights I want you to take from the financial statements. And then, of course, we go typically into the notes and into whatever the company has to share. And what is really, really interesting here is, of course, to learn a little bit more about what is actually happening. Now, for that, it's good to go always to the financial summary, in this case, item 2 of the 10Q. And what we can see here is that during the third quarter of 2022, port congestion, shipping container availability, and other supply chain pressures have improved. This has resulted in inventory arriving earlier than anticipated, which has resulted in increased cost of managing elevated inventory levels. So this explains a lot about the cost of sales, why it was increasing. The gross margin rate analysis and the inventory section on page 21 provide additional information. So let's go to that then. So if we go to the gross margin rate explanation, what we can see here is if you compare, and this is why I love these graphs, Merchandising, 2.8% contributable to this, and digital fulfillment and supply chain, also 0.7%. It's all mentioned here. What was really something that caught my attention is higher inventory shrink. And I thought, like, what the hell is this? Well, effectively, what I'm learning now is that just people are stealing a lot in their shops. Not only at Target, it seems to be an industry-wide problem at the moment. Most probably also created due to the economic circumstances that people are having now. As they mentioned also in the transcripts, people are not anymore pulling from their savings. It's getting really tight now for them, and this is an anticipated headwind for the company. But it also means that their customers are becoming more inventive and trying to get their goods without paying the bill. They commented a little bit more about that also in the investors call, and I will show also some of the highlights from there, which I think are important for us to know. But before we get there, I want to show you one more thing which I think shows the power of this company. Look here. They have an after-tax return on invested capital of 14.6%. Of course, it was 31% last year, but for me, last year is really not representative. But if your cost of capital is, let's say, 7%, they are earning for us as shareholders 7% annually. This explains why a company can, over the last 50 years, almost grow or hike its dividend by an average of 12%. I mean, this is for me really, really impressive. And as you could see earlier, they still have a lot of market share to grow. Last but not least, then the notes about the inventory. It was 17.1 billion as per the ending of the quarter. And the increase over the balance of earlier primarily reflects the following. Earlier than expected inventory receipts, as they mentioned, lower than expected sales in our discretionary categories, partially offset by actions taken during the current year to reduce excess inventories, and increased in unit cost across all of our categories, which is another word for inflation. At the same time, they were also really having almost no inventory last year because of all the supply chain disruptions and really many people buying stuff in their stores. So, that's why last year's numbers were really inflated. They were looking way too good for what the company was really representing. And which is then interesting, of course, is that the shareholders, they buy massively. They thought like, let's extrapolate this into the future. And they were willing to pay $250 for this stock while it's trading now at $150. You can see how short-term investors are typically oriented. But we are long-term investors. We do our homework. Last but not least, if it's a good reminder of being a long-term investors, they have paid dividends every quarter since 1967, and it is their intent to continue to do so in the future. This is music into my ears. And if you didn't even get horny yet from the dividend growth chart, then maybe this will help. Okay, last but not least, if we then go to the quarter app, you can get here all the investor call transcripts, which are really, really good. So they talk a little bit about inflation, how it's hitting them, the gross margin, financial headwinds for compared to last year's, and an increase in FEF. We knew this. But what was really interesting for me is like the CFO mentioning our inventory is in a much healthier position than earlier in the year because the heaviness you're seeing today is due to the early arrival of fresh inventory we are planning to sell. And also nearly 90% of our key programs have already moved into our distribution centers and stores. At the same time, if you're investing in shipping, in container shipping, look at this. Container rates in global shipping have come down by about a third in recent months, and we'll realize that benefit in 2023 as we renegotiate our staggered contracts with shipping partners. So I think you will see some headwinds here, and this is why I always say read the earnings reports because it makes you a better investor. If you're still investing at the moment in container shipping, watch out, those dividends that you are getting there, they might really not be realistic because companies like Target will try to get to the bottom of saving their costs also on the container shipping. Okay, I think it's enough for here now. If you're more interested, ask me anything. I've been really going through all the details here, but I think it's time to really start looking at what this company is worth. So we know this company is having currently headwinds based on inventory, a weaker consumer demand that is more price sensitive and more looking at promotions. And at the same time, therefore, they have lowered their earnings expectations. They even talk a little bit here about the gross margins and the cost savings program that they are having and what its impact will be. But what I do think is that the levels that we have seen last year are probably not realistic. And we'll take that into account when we are doing our fair value estimation. But before we get there, let's have first a look at their dividend safety profile. So I think their dividend is safe. A score above 60 is just a good score in the model that I'm using. The free cash flow growth, I had to enter it on 0 because it's a negative number because of this year's exception. That's why I gave it anyway 0 points. But on average, if you look also at the earnings growth, 9% over the last 5 years, which is really good. A strong balance sheet. Debt to equity is high because of share repurchases. That's something of our era, 2023. It's not something I'm always happy with, but the interest is easily covered. I also looked into their debt schedule, and also there I don't see any issues. I believe that their interest rate is not going to give them any problem in the near future. 50 years of growth, 5-year dividend growth average of 13.24%. Their last hike was 20%, and during the last recessions, it was always increasing their dividends. If I look at a company like Target, having studied them, I think that their growth prospects are still strong enough. So hence why I believe this dividend is safe, and probably even more than safe. And I can really imagine it with this kind of management and this kind of attention to innovation, and all the time, being really early with remodeling to keep the customer really happy. They should be able to do it another 25 years. If we look at more the trend pages, what you can see here, what I find really important is in general that the free cash flow per share has been slightly increasing. If you compare to 10 years ago where it was 3.12 per share, last year 10.41, but let's take an average around, let's say between 5 and 8 on average, except for this year where you can see that some of the free cash flow that was brought forward, they are paying the price for right now. And you can see also that they've been buying back shares. So there's always coming with a delay, as you can say, here at the major free cash flow, but the next year they decided to allocate that cash to repurchase shares. At the same time, it has been really helping because the shares, they declined in size from 628 million to 462 million right now. So it has not been just repurchasing shares to buy back employee option contracts. No, it has been really going into our pockets as shareholders. Balance sheet looks good, nothing to worry. It only recently, therefore, became with their long-term debt larger than the equity to shareholders. Equity is, of course, declining because of the share repurchases, and this is what I wanted to mention earlier. Now, if we then go to the overall statistics of the company, a current yield of 2.84%, Chowder rule of 16%. I don't know if we see in the next 5 years 13% growth again. I think they will do it a bit lower. This is what we typically see here in the good years and in the bad years. In the good years, it goes really up. That's the last 10 years. But during the bad years, it's typically a little bit lower. EPS payout 60%, free cash flow payout doesn't really make a lot of sense at the moment to look at it, but they pay a dividend of $4.32, and I mentioned already, generally their free cash flow power is between $5 and $8 at this moment in time, so it is nicely covered. I believe that the price to earnings is still 20, is still a little bit high, or 19. But that's what you pay for a high quality company, and I also don't think we have seen the bottom in share price yet. Having said that, let's look at what we want to pay for this company. So, on average, what you can see here is in 2019 it was doing around 4 billion in free cash flow, 3.2 billion in earnings, and also that 4.3 billion in 2017, 4.4 billion in 2015. So what I would like to estimate on is, let's say, the 5-year average, which I'm taking at around 4.2 billion. So if we take this 4.2 billion and we believe that this is the baseline to operate from, with a growth in the first 5 years of 5%, 3% thereafter, I'm using here a discount rate of 11%. I don't want to use 10% because of the economic headwinds. I expect a little bit more return. But as this is really a slow grower on average, and it has less risk involved than some of the other companies that I sometimes analyze, I'm not using 12.5%, but 11%. At a terminal multiple of 15, which is significantly lower than the 19 that we see, I believe that the fair value of the company is 130. So why did I initiate a position then? Because I'm also looking at the optimistic case of 7% growth and 4% thereafter, and at a terminal multiple kind of similar to what it is trading at today of 18, then I believe that the fair value of the shares is $159. Now, I wanted this company already for quite some long time, already back in 2017. So I just bought 7 shares in this company. It's really not a lot, really just to initiate, to start monitoring the stock. And if I'm honest to you, this is kind of a purchase to make up my regret for not having bought them in 2017. It's meeting all my screener criteria with an attractive dividend yield of more than 2.75%. And you know, depending on how the company evolves, if the share price goes and comes toward 130, which I hope it does, then expect me to buy more. Probably it's yielding then around 3.2%, which is a really nice entry yield. So guys, this was my stock analysis about Target. I'm really happy with this new position in my portfolio. If you know my portfolio, I really love consumer staples. I was really big in Ahold already, and that was the only retailer in my portfolio, so I could really use a second one. One in the United States I wanted. Walmart is another one that I maybe could own in the future, but at this moment in time, Target is giving me the most attractive risk reward, and that's why I decided to initiate a position, taking the optimistic case into consideration, but expect me to buy more when it hits my fair value of around $130. Guys, if you like this video, hit the like and subscribe button, and see you next week.